Welcome back to the channel. In today's session, we'll dive into BDA Financial Management, December 2025, question 22. I will walk you step by step through the concepts, calculation, and exam techniques you'll need to master this question. Let's get started. Bella Catlego is the Marketing Director of Vesta Limited, a company that makes and sells electronic devices for use at home and in business. She is considering the launch of a new mobile model called Trex. The available data is not substantially reliable, though she still feels she can make a decision on whether or not to launch Trex. To start with, Trex is estimated to have a shelf life of 5 years commencing the year 2026. Trex will require the purchase of a machine at a cost of 100 million at the end of 2025, after which the machine will be sold for 20 million at the 5th year. Trex will have the following price and cost structures for the first year 2026 with expected inflation factors as follows. So we have the selling price, which is 500 and the inflation is 2% from year 2 onwards. Material cost, 200, 4% from year 2 onwards. Direct labor cost, 100, 5% from year 2 onwards. Incremental fixed cost, which excludes depreciation, 50 bob. The inflation is 10% from year 2 onwards. The company is eligible for capital allowances, that is depreciation for tax purposes, at the rate of 25% on reducing balance. And at the end of the project, when the machine is sold, any gain or loss on disposal will be considered for tax. The tax rate on incomes and capital allowances is 30%, and for this purpose, assume that tax for a given period is paid in the same year. The project will require an initial investment in working capital of 20%, which will be increasing by 5 million at the end of each year to cater for general inflation. But the whole amount, together with the periodic increase, will revert at the end of the project. Now, the following is the expected demand for the product for the next 5 years. So year and then units. 2026, 30,000. 2027, 40,000. 2028, 40,000. 2029, 30,000. And 2030 is also 30,000. Required. Compute the following. A, the payback period for the project. B, the discounted payback period assuming a discount rate of 15%. C, the net present value of the project assuming a discount rate of 15%. And D, the internal rate of return, IRR, of the project. E, the net present value of the project given various interest rates from 1% to 25%, and prepare a graph of the different NPVs. So total for this is 20 marks. So let's dive straight to the solution for our question. We have the solution. When handling the solution, the first item that I want us to start with is computation of relevant cash flows. So we want to compute of relevant cash flows, the computation of relevant cash flows, and start with the first one, initial cash outlay. So the initial cash outlay, then move up. They said that purchase of a machine at 100 million. So we have purchase of a machine. Purchase of a machine. Purchase of a machine at 100 million. So I'll truncate it in thousands. I'll be truncating this in thousands. And therefore this will be 100,000. This should be in million. Truncate that way. Now, once you have the purchase of a machine at 100,000, the next item that you've been given is that there will be injection in working capital at this level. The project will require an initial investment in working capital of 20 million. So there is injection of working capital, injection of working capital. This is 20,000. Now remember, this is depreciable. Depreciable. The depreciable amount. The depreciable amount. Then after that, this will be the total initial outlay. Add the two, alt equal, that will give you 300,000. This one was 20,000 and not 200,000. So the total is 120,000 as the initial cash outlay. The second part is investment in working capital. The investment in working capital. Investment in working capital. So we have here injection of working capital. Now, this begins in, because we have the first year commencing 2025. At the end of 2025, that is 5 years commencing 2026, but we also have 2025 at the end of the 2025. So we have 2025, then the project begins in 2026. This can be changed to general 2026, 2027, 2028, 5 years, 2029. It starts in 1, 2, 3, 4, then 2030. 2030. All this should be general. Now, in the first year, there will be an injection of working capital of 20,000. That the project will require an initial investment in working capital of 20 million, which will be increasing by 5 million at the end of each year. So the initial investment in working capital is 20 million, which means we use 20,000. Then it will be increasing by 5,000 or 5 million, which means this will be 5 million. A regular or annual increases of 5 million, 5 million, again 5 million, like that. They went ahead and said, which will be increasing by 5 million at the end of each year to cater for general inflation. But the whole amount, together with the periodic increase, will revert at the end of the project. So it means the end of the project is 2030. This will be reverted at the end of the project. These ones here should be equal sign negatives, or you can make them to be outflows by negating that, negate, then it will be recovered at the end of the project lifetime. That was put here. The whole amount together with the periodic increase will revert at the end of the project. So it will be reverted here, equal sign negative, then sum tab. You add all this up to 2029, close bracket. Remember, I negated, it will give me a positive figure. The total is 40,000. Now the injections are in 2025, 2026, 2027, 2028, and 2029, while the last period there is a recovery. So that should be injection stroke recovery, injection stroke recovery that way. And this can be cut and moved on the other side so that recovery can fit as well on that line. So the third one will be depreciation charges per year. Depreciation charges per year. Depreciation charges per year on reducing balance basis. Remember, the question said that it should be on reducing balance basis. So we have here, then depreciation. Depreciation charge. We start with the same years that are here now from 2026 to 2030. And depreciation charges per year. Now, The first one is in the depreciation rate. The company is eligible for capital allowances, that is depreciation for tax purposes, at the rate of 25% on reducing balance basis. That is 25% on reducing balance basis, which means that for us to get depreciation, that will be equal sign, bracket, you take the depreciable amount, which is 100,000, then times 25%. 100,000 times 25%. You can log this because it's a constant. So log the 100,000, then multiply the 25%. So the first one is 25,000. In 2027, you drag this across, then this will be, now the first one, minus depreciation already charged, that is minus depreciation already charged. You can log that as well because it's a constant. This should be in bracket, and remove this bracket, then enter. The answer is 18,750. Drag this across again, double click. Then now just less the 18,750. Lock that because it's a constant. Enter. Then again drag across, double click. Then after this, minus the one for 2028. Then lock that with absolute sale referencing. Enter. Then again drag across, double click. Then again minus, remember it's on net book value, that is cost minus accumulated depreciation. You less the depreciation for 2029, lock that with F4, absolute sale referencing, and enter. That becomes our total depreciation charges over the years. You can go ahead and get total. What is the total depreciation for the entire period? Total depreciation, that will be equal sign, sum tab. You sum all this to get our total depreciation and enter. The other item that we need will be salvage value and gain stroke loss on resale, on resale of machine, Now on this salvage value and gain stroke loss on resale of machine, you start by getting the resale value. Now resale value has been given somewhere. Where is it? Trex will require purchase of machine at 100, after which the machine will be sold at 20 million at the 5th year. So that is 20,000, which means that we use 20,000 here. 20,000. That will be the resale value less a net book value, the net book value. Cost, what is the cost? Now the cost is here 100,000 less accumulated depreciation. Now the accumulated depreciation is 76, the one that we've just computed up there, equal sign negative, then click on 76 to 70. Then after that, this will give you equal sign, summation of these two is 23,730, and I need this to be deducted, so I'm negating that. This will be loss on resale. Can see it's a loss because the resale value is less than the book value. So this plus the net book value, and it is 3730. That is loss on resale. Then tax saving. Remember, this is a tax saving because you've gotten a loss on resale. Tax saving on resale. Tax rate has been given as, so the tax rate has been given as 30%. The tax rate is 30%. So we have 30%, and remember they said, that the company is eligible for capital allowances at the rate of 25%, and at the end of the project when the machine is sold, any gain or loss on disposal will be considered for tax purposes. So that will be considered for tax, and the tax rate is 30%. So the tax rate is 30%. That therefore means that gain will be equal sign tax saving on there's an error there. This will be tax saving on resale. That way, and that will be equal sign 3730 times negative. Since it's a saving, it will be an income. That is an inflow of 1119. So the tax saving on resale is 1119. After the tax saving, we want to compute the annual cash flows. Now the annual cash flows. Now for annual cash flows, we have the years. We've been given the years. And the first year of concern is 2027. So we have 2027, 2028, 2029, 2030. Those are 5 years, or for 1, 2, 3, 4. It should start from 2020, to confirm that, 2026, 2027, 2028, 2029, and 2030. So 2026. This should be general that way. Now, those being the years, what is the demand projections? Before that, we can bring in the shillings truncated into 000, or we can start with the demand, and this is truncated. This is truncated, which means that if we have demand there, then we can bring in the truncation, 1, 2, 3. Then this can be used across throughout that way. Now demand has been given. You move up to this level. We have the demand for all the periods. You can just copy this. We want them to be truncated. The first one is 30. That will be equal sign. You can just use 30. Because this is 30,000 and things are truncated, 30, 40, 40, then 30, 30. So 30, this is 40, this is 40, then 30, again, we have some 30 there. So they have been truncated. Now after that, we move to the selling price and other cost structures. Trex will have the following selling price and also cost structures from 2026 with the expected inflation. So selling price is 500. So we have selling price of 500. Start with selling price here. And that has been given as 500. The first one is 500. Inflation will be 2% onwards, which means that you will say equal sign 500 times, open bracket, 1 plus 2%, because it's increasing by 2%. Enter, then drag across. That is for the selling price. Once we have the selling price, this can be cut just down. Once we have the selling price, the next item is material cost. Material cost. Can just drag down. So material cost will be equal sign, move up 200. So we'll be picking 200 and it's increasing by 4%. So this is 200, then it will increase by 4%. So equal sign this times, open bracket, 1 plus 4%. So it's 4%, close those brackets and enter, then drag this down. After that, there is direct labor. This can be dragged down. All those can be dragged down. Let's see if it's 200, 200. No, this is 150. So we have 150, and the last one here is 50. Now the first one is increasing by 5%, then this one is 10%. 5%, 10%. So equal sign, this times, open bracket, 1 plus 5%, close those brackets, enter, then drag across. If you drag this down, this one is increasing by 10%. You can just change this to 10%, enter, then drag this across. So this can be centered. But remember, this is an income while the others are costs. So I can make this to be a negative. We'll negate all those others, equal sign, then negative. All the others will be negative. Then this one will also be equal sign, then negative. Equal sign, negative. The others will all be negative. Then we'll get our contribution per unit. Contribution per unit. Contribution per unit. Alt equal. So you add all this, enter, then drag that across to get our contribution per unit. Once we have our contribution per unit, you can get our total contribution. Total contribution, that will be the units sold times CPU. CPU stands for contribution per unit. So this will be equal sign. The unit sold, this is 30. So equal sign, then 30 times, then you multiply with 150, enter, then that can be dragged across. Now, once you have contribution per unit, the next item will be depreciation expense. Depreciation expense. The depreciation expense, we had already gotten the depreciation expense, and depreciation expense were here, charge per year. So this will be equal sign, negative. Then our depreciation expense are from 2026, 25, enter, then drag across until we have the last one. But looking at this, there is no way depreciation expense would be more than the total contribution per unit. So it seems something somewhere is wrong on what we've done. Maybe this was not supposed to be truncated. What if we write here 30,000? Because this was 30,000, 30, 40, 40, 30, 30. What if this is 30? 30,000, what will happen? So if this is 30,000, then this will again be so much. This is again so much, 4,500,000, which doesn't make again sense. Remember, we had truncated 30,000. We had truncated the units here because we also truncated up from the 20 millions, we truncated with thousands. That's why I truncated this one as well. Now, this question was a replica. Revert this back to 30. This question was a replica of December 2022. Exact same thing in December 2022. And perhaps we can see, we can view back and see what was the problem or what is different from what you're doing here. Because you're getting depreciation of this, which is way, way above the total contribution of this other one. So let's see December 2022. December 2022. So looking at December 2022, you can see the same question. December 2022, question 22. Everything looks good. They repeated the same question. Everything looks good. Of course, this probability was not there. That was omitted. But the only place I see a difference is this part. Remember, here is 5,000, 2,000, 1,000, and 500. While the other one has 500, 200, 1,000, and 550. The other one has 500, 200, 100, and 50. So I believe the issue was here. The same question, but it seems the other one was given different values as far as the selling price and cost structures are concerned. So that may make me to adjust that. I'm going to use 5,000, 2,000, 1,000, and 500. This is the question for December 2022, question 22, which was the same question as the one that was brought in December 2025, question 22. So it seems the cost structures, selling price and cost structures here, the selling price and cost structure, some zero was omitted. So I'm going to rectify that perhaps and include the zero there. I'm going to assume that that is the error that was made if you look at this question compared to the other one. The reason is total contribution here cannot be way below the depreciation expense that we have gotten at this level. What I'll do is to increase this, go to the cost structures, and this now should be 5,000. One that follows should be 2,000. The one that follows should be 1,000. And the one that follows should be 500. So if you do that, all the other factors remaining constant, then you realize that at least we have this. The total contribution, 139,500 for 2026, and the rest for the other years. Now we get profit before tax. The profit before tax will be as follows. Alt equal, enter, then drag this across. Then we have the income tax expense at 30%, income tax expense at 30%. This will be equal sign 114,500 times 30%. Enter, this should be a negative. Then drag across, drag that across. Now after getting that, we want to get profit for the year. Profit for the year. Alt equal again, you add these two, enter, then drag across to get our profit for the year. So as I changed, this is the profit for the year, but after changing this, only the selling price changed. So you also change the others. You also change the others as given. That will be equal sign negative. Then this will now be 2,000. Yeah. Then this will be equal sign negative. Make sure that it reflects to that formula, 1,000, comma. Then the last one will be equal sign negative. Then we pick on this here 500, so that all of them are changed. 5,000, 2,000, 1,000, and 500. That changes everything. This is the profit for the year. Then you add back depreciation. Add back depreciation. Depreciation will be equal sign negative. Click on this, enter, drag across. Then this will give us our cash flows. Cash flows. Cash flows will be profit for the year plus the depreciation charge, enter, drag this across to get our cash flows. So after getting cash flows, you move to adjustments. Adjustments. A few adjustments have been given. So the first adjustment is resale value of machine. Now the resale value of machine has been given up there. So equal sign, you move up, and the resale value of machine is 20,000. That is an inflow. Then we have tax saving. Tax saving on resale of machine. Tax saving on the resale of machine, equal sign. Now the tax saving is here. It's an inflow, 1119. Then injection stroke recovery of working capital. Recovery of working capital. Injection stroke recovery of working capital. And that will be from 2026, that will be equal sign. We had that computation here. So investment in working capital start with 2026. Then just drag this across. Injection stroke recovery of working capital. We also have one that was in the year 2025, that is year zero, that is included in the investment or the initial outlay. So adjusted cash flows, adjusted cash flows will be alt equal and sum from the cash flow that we have up there, enter, then drag that across to get our adjusted cash flows. So that becomes our adjusted cash flows that will be used to compute NPV, payback period, IRR, and other relevant items that were required in our question. Now, once you have the relevant cash flows, the next part is that we want to start solving the question now, and we start by getting payback period. So payback period, payback period, payback period. Now, for us to get the payback period, then we need to get the formula for payback period. But before that, give me the cash flows. So we have here, then cash flow. Then here we have cumulative cash flow. We also need cumulative cash flow. Cumulative cash flow. So here, call sign. There is year 1, 2, 3, 4, 5. Year 1, 2, 3, all the way to year 5. The cash flows are given here. So you copy this, Control C. Then we want to transpose. So transpose, but that is not working. So what we do, first, I want to copy. Right click and paste as values. Paste as values. Then now copy this. Control C, or you can cut. Then here, transpose. Transpose. So you copy, then right click and transpose here so that we can have those cash flows. Then you can delete this. Clear content. Then cumulative cash flow. The first one will be 34,000. The next one will be equal sign, take 34 plus 40. The other one will be equal sign, take 74 plus 36. The other one will be equal sign, take 110 plus 24. The last one will be equal sign, take 134 plus 87 plus 87. So these are cash flows that we want to use to compute PBP. Now the payback formula is as follows. This is the payback formula. So X, then can paste here, payback formula. This can be cut, remove this. So PBP is equal to payback period is equal to cash before full recovery. That is year before full recovery. So this is the formula for payback period. So payback period is equal to year before full recovery plus cash flow to payback amount over cash flow in the final year. Now to solve this, we have the first item, which is the initial cash outlay. So we start with the initial cash outlay. This has been given as initial cash outlay is 120,000. Then cash to payback amount, this can be cut here. Now cash to payback amount will be equal sign. Remember, this is 120. This is 120, and if you want 120, then year 1, year 2, year 3, you have to get it in year 4. That therefore means that cash flow remaining to payback amount will be 120 minus what we have here in year 3, which is 110,880. So you less 110,880. that is 91.20. And finally, cash flow in the final year, the cash flow in the final year will be equal sign 24,061. That is 24,061. That is to tell us that PBP is equal to now year before full recovery. If the initial outlay is 120, then year before full recovery is 3. So that is equal sign 3 plus, then open bracket. Cash flow to payback amount is 91.20. Then divide that with the cash flow in the final year, which is 24,061. 24,061, close bracket and enter. This can be improved to how many decimal places? 2 decimal places. So that becomes our payback period, 3.38 years. This can be brought here. Then you write here years. Now, after getting payback period, the second item was number B, discounted payback period. So number B is discounted payback period. Discounted payback period. So discounted payback period, same way of doing things. We equal sign, click on this, enter, then drag down all the way to year 5, drag across, cash flow. Once you have the cash flow, get present value interest factor at 15%. That is the present value interest factor at 15%. And equal sign. Remember 1 plus r raised to power negative. That will be equal sign to bracket 1 plus 15%, close bracket, raised to power negative 1. Enter. Then increase this to 4 decimal places and drag down. Then this one can now be changed to 2. This is year 2. This can be changed to year 3. This can be changed to year 4. Then this can be changed to year 5. Then after getting that, we can get the present value. Present value will be equal sign 34 times 0.8696, enter. Drag this down to get our present value. Then you can get cumulative present value. So equal sign, the first one is 29. The second one will be 29 plus this. The third one will be 60 plus 23. The other one will be 84 plus 13. And the final one will be 97 plus 43. So that's how you get it. Now, once you have cumulative present value, you again get back to this. So copy and paste here. The initial outlay remains 120. That remains the initial outlay. And this is supposed to be equal sign here. Again, equal sign, this other one. Now, cash flow to payback amount. Remember, 120. 120 is between 97 and 41. 97,000 and 141,000. So cash flow to payback amount will be equal sign 120 minus 97. Enter. Then cash flow in the final year will be equal sign. You just click the 43. This is the cash flow in the final year, which is 43 in this case. Then after that, we can get the payback period, discounted payback period, discounted payback period. Yeah. So this will be equal sign. 120 is between 97 and 141. So this will be a 4. So 4 plus, open bracket, cash flow to payback amount is 22, divided by cash flow in the final year, which is 43, close those brackets and enter. So this becomes 4.51 years. Remember, the formula remains as it is. A year before full recovery plus cash flow to payback amount over cash flow in the final year. So that is number B. Number C of the question, the net present value, assuming that the discount rate is 15%. So they want NPV now. NPV, can move it down. The net present value of the project, assuming that the discount rate is 15%. That is the net present value. So equal sign, give me the cash flows here. And here, start with 20. Okay, we can use it the way it is, all the way to the other one. Then these are the cash flows. Drag that down. These are our cash flows. Once you have the cash flows, we have the initial outlay. So equal sign, initial outlay. Initial outlay is 120. 120 equal sign, then 120,000. Rate 15%. The rate is 15% given. Now, NPV will be, we are going to use the NPV function to compute this NPV, and that will be equal sign NPV tab, but before that you can negate this. So that will be equal sign negative, so that it can be a negative figure. So equal sign NPV tab, the rate is 15, comma, the values are from 34 to 87, close those brackets, then add 120. You add 120. So this is a negative, so it will be deducting. So add the negative 120,000, enter, and this is 21,167. That will be our NPV. That is number C. From that, we move to number D, part D of the question. IRR, so internal rate of return. The internal rate of return, IRR. Now IRR again, we will have equal sign, then year, and cash flow, but this time round start with 2025. This one should be 2026. Then this is 2026 plus 1 becomes 2027. Let me drag down first and convert this to general. But this time around you start with 2025 and 2025 before you bring in the others now from 2026 moving forward. So this will be general, then to the end 2030. Now 2025 was the initial cash outlay, so equal sign negative 120. Then the others are from 34 moving down. This should be a negative, so equal sign, then 120 like that. Now IRR is a rate of return that gives you 0 NPV, and therefore that means that you don't need the rate, simply just get IRR. So IRR will be equal sign, use the IRR function. The values are here from 120 to 87. Select all of them, close those brackets and enter, and that will give us 0. You can convert this to percent, then Two decimal places, 21.37%. That becomes the internal rate of return. That is number D. Now from number D, the last part of our question was NPV of the project given the various interest rate from 1 to 25 and prepare the graph for the different NPVs. So that is the last part of the question, which means that you simply get the NPV if you've been given different interest rates. So this will be rate, cash flow, rate cash flows, and NPV. Rates are 1%. They said 1%. So equal sign again, this one plus 1%. Then drag all the way to 25. They want up to 25. Up to 25. Yeah, that is 25. Cash flow. Cash flow is equal sign. This is the cash flow. Pick the way it is here. Cash flow. Drag down. Up to there. Now they want NPV if those are the cash flows. So use the NPV function. That will be equal sign NPV tab. The rate is this, comma. The values are select from 34,000 to 87. Don't select the 120. This is an outflow. Select from 34, the inflows, to 87. Then lock with absolute cell referencing F4 to include the dollar sign. Close the bracket. Then add the initial outlay of 120,000. You add the negative 120. Lock that with absolute cell referencing to see the dollar sign. Enter. Get your NPV and drag down so that you can get the other NPVs. So those are the other NPVs of the project. Now after that, they said, and prepare the graph of the different NPVs. So you can confirm that if the rate of return is 15%, NPV is 21. And you can see 15%, NPV is 21,167. The same one that we had gotten up here as 21,167. So after that, they want you to prepare a graph of the different NPVs. Graph of the different NPVs. So pick from rate, moving down to 25%. Hold down the control key and pick from NPV all down to the last NPV here. Then they want us to come up with a graph for the different NPVs. Go to insert, recommended chart. Recommended chart. Can pick any of these charts. Any of these charts. Then this one is okay. Different NPVs at different rate of returns. Can go for this. Okay. So this gives us a graph showing a different NPVs at a different rate of returns. We can edit this and get correct grid lines, the axis titles as well. So I'm changing the chart type, change chart type. I'm going to pick another one, second one here, this clustered column, then okay. So under this clustered column, I think it gives more, all the rates are given there. So 1 all the way to 25 and also their NPVs. So this will be a chart showing NPVs a chart showing NPVs at different rates. A chart showing NPV at different rates. So this will be rate. This one here will be NPV. Rates and then NPV. Is there a need for legend? Let's see. Legend, NPV. That's okay. If you want, you can change the color of your chart. So that was 10 marks from part E, the net present value of the project. Given different interest rates, what was the NPV on at those different interest rates? So that is what was required in December 2025, question 22, financial management in the BDA paper. All the way from what we got, you compute the relevant cash flows, the initial cash outlay, incremental working capital, depreciation charges, the salvage value, the loss on resale, the annual cash flows as we've gotten, though we adjusted somewhere there for the selling price and cost structures, the ones that were given were not giving the accurate values. Then after getting the adjusted cash flows, you get the payback period, you get the discounted payback period, you get the net present value, you get the IRR, and you get the different NPVs at different rate of returns. See you in our next session.